Welcome to the Finance Garage podcast, your go-to podcast for navigating the world of finance. I'm Jonathan, your financial guide, bringing the latest market trends, investment strategies, and financial news that matters to you. And by the way, I'm also going to share my other passion, which is cars.
At the SWU Group, we help everyday families achieve financial success. Our integrated services include financial planning, accounting, credit advisory, and estate planning. We're here to guide and support you every step of the way, from custom investment strategies to maximizing tax efficiency. We ensure your financial goals are met with peace of mind. Visit simonwu.com.au for more information.
Hey everyone, welcome back to the Finance Garage. As always, Jonathan Wu here, Senior Financial Advisor and Principal at the SWU Group. Today, we're exploring one of the most important parts of investing, and ironically, it has nothing to do with markets. It's actually about us. Our emotions, our instincts, our blind spots, these often matter more than interest rate movements or earnings reports. And I'm joined by Anthony Doyle, another friend of the show, Chief Investment Strategist at Pinnacle Investment Management, to unpack the world of phenology, where finance meets psychology. We're going to explore the behavioural biases, mental shortcuts, and emotional traps that constantly hurt investors, and more importantly, how to identify them in the first place for yourself and how to potentially overcome them. So whether you're a seasoned investor or someone who just wants to make fewer "what was I thinking" decisions, this episode will help you understand not just why we make mistakes, but how to protect yourself from them. As always, remember this podcast is for entertainment purposes only. We are not giving any form of personal financial advice, and please tune in at the end to listen to the disclaimer. And with that, enjoy. Hey Doyle, welcome back to the podcast.
Cheers, Jono. Great to be here again.
Now, we talked about the outlook for this year a couple of months ago. You got everything right, as I expected. But today we're going to talk about something a bit different. Like, you've spent the last 2 decades plus speaking to investors, right? Different types of investors. I know you've spoken at NAB trade days to retail mums and dads, high net worths, normal retail mums and dads, sophisticated financial advisors, and you have a lot to do with a lot of CIOs for the affiliates within the Pinnacle investment group. And so today I wanted to sort of unpack not markets, but this concept of phenology, which has sort of been a little bit all the rage in the last, let's call it 3 to 5 years, all right, which is the combination or the intersection of finance and psychology, right?
Yeah.
And, as financial advisors, we spend a lot of time trying to break down biases that clients have, which leads to decisions that they make or do not make. And then how do we steer them in a better direction to, simple things like not always look at your portfolio every 5 seconds to see how much money you made, or, have risk aversion, or things like anchoring and, things we're going to talk about today. I want to sort of hear your take on these things because you probably see it across a more broader spectrum than I do, because I'm just looking at it from my own client-based perspective. If I start with the most simple question, why do you think humans are naturally bad investors?
It's how we evolved. It's evolution. If you think about who survived and how we survived and why we evolved, it was because of human behaviour and biases and heuristics that we have embedded with us from the day that we're born in our genes, and will continue on past into our children and grandchildren and so on and so forth. And so when you get markets in particular, it's the interaction of buyers and sellers with different motivations, different time horizons, different risk tolerances. And it's why markets can never be efficient, because essentially you're not dealing with computers, and certainly there are a lot of algorithmic style approaches and quantitative style approaches, systematic style approaches out there that aim to reduce the impact of behavioural biases, for example. But there's a lot of human behaviour as well, and in particular fear and greed. And so it's important to recognize these traits within yourself. I would suggest, in order to stand the greatest chance of having success in terms of investing for the long run, you work hard for your excess savings. By its very nature, you saving capital or saving money means you are putting off consuming something today for something more rewarding in the future. And if you want to have the greatest success of generating and compounding returns over a long period of time, well, studies have shown that the investor's worst enemy is typically themselves. So it's a classic case of most individuals will buy high and sell low. Feels more comfortable buying something that's been on a big run, tear, and it feels quite uncomfortable buying something that might have fallen on more difficult times. And so with that in mind, it's really something that comes, I think, with experience, time in the market, getting to know yourself in terms of how you react during difficult periods, but also how you react when times are more fruitful and times are good. And so, as I said, it's something that's evolved with us since we came off the plains in Africa. It's permeated in an agricultural type livelihood on the farm, and when to sow seeds and when to harvest. And it will continue on long after we're gone as well, I would suggest.
Let's talk about the first big issue that I see a lot, and you probably see as well, is loss aversion. We're so innately scared of losing money.
Yeah.
And the psychological impact, which has been, written to death in academia, is if you put $1 into the market and that dollar becomes 50 cents, it is like double or triple the psychological impact of that dollar going up and becoming $1.50.
Yeah, windfall gain. Yeah.
Correct. The difference is not materially different, but it seems, depending on which side of the coin that you landed on, loss aversion has led to a lot of people losing money, right?
Yeah.
And then the emotions sort of set in. I mean, do you have any, let's not use the word advice, but do you have any, rules that you could think of to stop people from falling into this loss aversion, trap?
Yeah, I mean, if something halves, it's normally for good reason as well. So, I mean, throughout my career, I've worked with some great portfolio managers and investors that use different tricks and tools in order to mitigate some of these biases and heuristics. One, obviously, if something halves, the most appropriate thing is to review your investment thesis and see if something has fundamentally changed that has broken that thesis. If you invested in the first place and you think that it was going to move higher, why has it not done so? Is there something critical to the thesis that you missed? If it remains true, if it remains accurate, if you still retain your conviction in that company or in that stock or in that position, then arguably you should be allocating more. It's an even better opportunity than it was yesterday when you were paying a higher price for it. I mean, the market can often react in the short term as well, providing opportunities for investors to allocate if there is some sort of breakdown in terms of the outlook, or if there's been some sort of earnings downgrade as well. The other thing that portfolio manager in London I used to work with has done is, write down before anything went wrong or anything like that, how would I react if this position halved?
Interesting.
On a post-it note, and then refer to that post-it note.
If it happens.
Yeah, if it happens, yeah. And, again, you often see that in times of market stress that the positions within markets become highly correlated, and often it is fear that is driving markets, but it might not just be fear, it might be a technical element of forced selling, leverage, margin calls, etc. And often in times of those periods of market dislocation, it's the long-only retail investor, what we call real money, that can step in and actually take the other side of the position. So when people are selling for no good reason, which is why I'm saying, go back to your investment thesis. Why is this position falling? And if nothing has fundamentally changed, then arguably you should be allocating more to the position. That's how you generate long-term excess returns over time.
Good point. Now, one that's closely linked to loss aversion is the concept of anchoring. right?
Yeah.
Now, in consumer world, our anchoring, I always like to use the flat screen TV. It's not so much flat screen, but it's like, OLED TVs or whatnot, right? I saw it on Black Friday sale and it was $2,300, let's say. Well, that's my anchor,
Yeah.
right? It should never be higher than that, and that's how much I'm willing to pay. In the investment world, mixing loss aversion and anchoring together, I've seen umpteen numbers of investors would say, I bought X stock at $1.
Yeah.
It's fallen to 50 cents.
Yeah.
I'm never going to sell because one day we'll get back to $1. Now,
Yeah.
to this point that you said, something's fallen. It's fallen for a reason.
Yeah.
Whether or not it's been, fallen to an extremity is a different question.
Yeah.
Depending on context and situation. But is anchoring very dangerous to investors as well?
Yeah, totally. So, I mean, that scenario that you describe, 100 to 50, for example, could be a value trap, quality trap, growth trap. You've lost 50%, but then to get back up to 100, your entry price, the price has to appreciate by 100%.
Correct.
50 on 50.
Correct.
And so, in terms of danger from an anchoring perspective, both you're anchored to a certain price and you're not going to sell until you get back there. Well, obviously, there's an opportunity cost to that. So even if you've got $50 left or 50 cents in the dollar left, is there somewhere else you could allocate that capital where you could generate a return that will compensate you quicker than, say, the stock going back to 100? But it might never get back to 100.
Well, that's exactly the problem.
The other thing is, let's say that, the market was wrong, you were right, you get to 100 and you sell out. Well, often I see investors sell out or, clients sell out for no other reason than they got back to their entry price, and actually the stock or the fund could go well beyond that $100 price. And so selling your winners too early is a big problem. That's often the most difficult challenge that investors face, because they, as you say, in terms of loss aversion, you've made $50 on the position, you don't want to lose it. And so you lock it in, but the stock might actually increase many magnitudes. And Amazon's been a good case in that. Nvidia as well. I'm sure there are a lot of investors that held Nvidia and it doubled in price. You're like, you beauty, I'm going to move on and invest that somewhere else. And it's up like 16,000% or something like that. And so again, it comes back to, you've got to understand that and assess the fundamentals and look at earnings, because in the short run, prices will move for any magnitude, any number of reasons. I've got colleagues that ask me, why is this stock up or down? And it's just more sellers than buyers and more buyers than sellers on a day. But if you invest for the long run, then share prices typically follow earnings. And so if you get the earnings path right for a company, you'll find that the share price will often follow. It's very hard for a share price to fall in value if the company is continually upgrading earnings. And it's very hard for a share price to keep rising if a company is continually downgrading earnings. And so that's the focus of what fundamental investors are doing every day. And often what you'll find is that the longer your time horizon, then the easier it is to establish that relationship between earnings and price.
Correct.
The shorter the time horizon, the more it becomes a coin toss.
Yes, very much so. We talked about this at the beginning, as in the biggest thing that destroys investor behavior and why we're naturally bad investors is actually because we're overconfident.
Oh yeah, well everyone thinks they're an above average driver, right?
Exactly.
Like 70 or 80%
of people think they're above average driver. And so the same theory for investors. They believe they could either time markets, pick winners, outsmart professional managers. What anecdotal, or just theoretical points can you? I'm going to try to be very euphemistic here, but sincerely advise retail mum and dad punters as to why they're not smarter than professionals.
Yeah, I mean, as you say, I do a lot of sort of direct investor presentations, and I sort of empathize in that there's a lot of jargon and lingo in any profession, particularly in finance. And so I wouldn't expect, and when I'm doing these presentations, I attempt my best to reduce the level of lingo and jargon, because I wouldn't expect me to go into a convention of cardiologists and them to be presenting the cutting edge techniques for doing heart surgery and undertaking heart surgery, and me being able to understand what's going on. And really, like any profession, it's a full-time job. And so it's difficult if you're a school teacher, one of the hardest jobs in the world, as we all found out during COVID, with kids staying home during lockdown. And you're going to school 7:30 till, 4:35 in many cases and beyond. And then you've got to try and keep on top of everything that's going on with the company, or the market might move in a particular way, or the price of a security might just move for no good reason at all. It might just be an institutional investor is selling because they've had a mandate loss, or they're buying because they've had a mandate gain. And so it is particularly difficult if you're not embedded in analysing markets, day in, day out, to keep on top of, is this something I should be concerned about, or is this something that I think is an opportunity, or is this a risk to my portfolio? And that's why the value of financial advice is so important, whether it's in building diversified portfolios, but also I'm sure you get many clients calling you up, Jono, in times of market volatility, is this something I should be worried about? What should I be doing? And so it really is, I think that if you are going to part-time it, you're going to get average results, or maybe below average results. And the great unfortunate thing is many investors approach markets, maybe they have some degree of success, they then begin to underperform and they never come back to markets. They say, that was a waste of time, I'm just going to invest in term deposits, or invest in cash. And so from my perspective, it is an extremely, extremely challenging profession, one that is difficult. I think that investors can have success in it, but equally, you don't do your own will without seeing a lawyer. You don't do your own heart surgery without seeing a cardiologist. It's often best left to the professionals, I think, in terms of if you want to have the most optimal results for your hard-earned savings.
Ready to take the first step in investing, or just looking to continue growing your wealth without being inundated with financial information? With SWU Online Invest, we offer a range of expertly managed portfolios designed to match your investment needs. Whether you're a seasoned investor or just getting started, know that we will work tirelessly to ensure your investments are strategically positioned to maximize your goals. Visit swuonlineinvest.com.au today.
Now, let's talk about AI, because it seems to be forever in a day that everyone's talking about it. We hear it through narratives. We then see the outcome of it being FOMO and herd behavior. Every company is doing an earnings announcement and inserting the word AI, and then they think they're really cool. How should investors be careful about navigating this whole AI narrative and being scared of missing out?
Yeah, I mean, it goes both ways, right? Both on the bull case and the bear case. And I think it's important to, again, behaviourally speaking, we're conditioned to seek out bad news as well as humans.
That's true.
And so the reason we, again, survived was, is that a stick over in the field, or is it a snake? And if we were more cautious, then typically we didn't get bitten. But if we were a bit more laissez-faire, then our ancestors might not have had the opportunity to pass on their genes. And so with that in mind, the financial news media and the media in general exists to sell advertising, and the ability to do that depends upon eyeballs reading content and viewing content. And the reason they can do that is to be as alarmist as possible. In a world of social media, that becomes magnified. And so no one is ever going to write, it was a great day today. Nothing happened. Everything's pretty under control. Don't worry, you're going to be just fine. They're going to tell you all sorts of stuff in order to try and get your attention. And so with that in mind, it's important to recognise that narratives go both ways. And some of the most dangerous narratives often come from friends and family, I would suggest, of some sort of tip that they've heard Someone spoke about it, someone that they think is an insider. I'm not saying trade on inside information, but someone that they think has some sort of insight, and ultimately doesn't. The great old story. You're in a bull market when the taxi driver tells you about their portfolio, or the taxi driver's quitting to run their portfolio.
Correct.
And so I think in terms of assessing market narratives, again, it's a difficult thing to do. I mean, who's to say what the world looks like in 10 years? I'm sure when we were there, casting your mind back to January 2020, and we were going through those bushfires at the time, it was obviously terrible, but no one predicted a global pandemic, and COVID was starting to hit the airwaves at that stage. And even right up until lockdowns, the markets didn't believe it, and just thought it was a bad flu. No one, because it's very difficult to predict the events that occurred post, say, governments deciding to enact lockdowns and shut borders, and what we still didn't even know how they would attempt to support their economies, and what that meant for companies and equity markets and labour markets and so on and so forth. And so again, it comes down to diversification and not having all your eggs in one basket, because we know that the future is uncertain, and there are many plausible types of scenarios that could occur in terms of the evolution of markets over the next 5, 7, 10 years, for example. And the main thing is to not get caught up in emotion. And one of the things I like to tell our clients is that the best investor is the Aussie homeowner. And why is that the case? Well, they typically buy with a long run view. They're buying the family home or what have you. They're holding it for 25 years. And they're not getting caught up in daily price movements of someone yelling at them what the price of their property is. And you can imagine what the impact of that would be if every time you left your home, someone yelled at you, I'll buy your house for $1 million.
Yes.
Next day they'll buy it for 900. The next day they'll buy it for 2. And with frictionless trade, you probably might be tempted to say, okay, mate, let's shake hands, let's do a deal. But there's obviously a lot of friction involved in selling your house, so it's relatively illiquid. You've got to find somewhere else to live. There's a big marketing campaign. You've got to paint the walls,
dress up the furniture,
dress it up, get someone in to stage it, all that sort of stuff as well. So I think in many instances, if Aussies and investors more generally took an approach to the stock market that they did with their own homes, they would probably have much better outcomes rather than getting caught up in, say, the next new thing, the next hot new thing.
That's very, very good. Last one, information overload.
Yeah.
Like it is, if you want to read about something, between the use of a ChatGPT or a Gemini or a Claude or whatever, you could find out anything and everything about a listed company, right? There is no shortage of news. But the problem is that if it seems like the more news you read about something, then the more confused you're going to be about what you do with that information. What's your advice to investors that just forever just look for, the next, piece of information to then drive them to maybe a decision, because it's dangerous?
Yeah, the paradox of choice and going to the supermarket, too many cereal boxes. Eventually in any transaction, you're taking the opposite view from the person that's either buying or selling off you, right? You're more bullish on a stock if you're buying, or if you're selling, then you might not even be selling because you think that the company's prospects are poor. You might be selling to meet a financial obligation like school fees, or so there's many different motivations for individuals buying and selling securities. But inevitably, the future is unknowable, and you can't know everything. And so often it's important to rely upon trusted sources, whether that's doing your own research, whether that's consuming content online, whether that's talking to someone that knows a bit more about finance than you do, or about the industry in itself. But where a place I used to work, Firechild, they would conduct 200 hours of research on a company before it was proposed at the investment committee, for example. So, and then of course there are others that are more comfortable investing with a lot less information at their hands and at their disposal. So I would suggest that it comes down to the individual, but you obviously don't want to be paralysed from investing because you're looking for the next new piece of information, because ultimately you may miss out on the opportunity if you see some sort of re-rating event occur. You ultimately have to become comfortable recognising that you're not going to know everything, because the future is by definition unknown and unknowable. I mean, you can make the odds as great as you can that you have success, but it's not a guarantee of success.
Correct. And I think that's the dangerous thing that people sort of mismatch in their minds.
Yeah.
Right? They think, 25 years ago, it was so much harder to find information, and therefore it's easy to find information today, and therefore easy to make money, where it's actually the opposite.
Yeah.
It's far, far bigger the opposite.
Yeah.
I don't think there's ever a time in markets where it's not volatile, positive or negative, right?
Yeah.
And investors always come to me and say, "Oh, well, Jono, markets have been recently really volatile," and I'll show them a portfolio and it's up like 12% in the last 12 months, right? And they're like, "Whoa, I thought markets were volatile." I said, "Yes, markets have been volatile to the positive, right?" What's your, final message and final question as to how do you think, and you may have already answered already, but how do you think investors are best suited when they just forever endlessly think markets are really volatile and therefore volatility equals bad news?
I mean, volatility is the price you pay for a higher returning asset. And if you don't want any volatility, then you can take your money out of the bank and put it under your mattress. Because even, there's a risk with investing in a bank that there's a run or very low likelihood of that occurring, particularly in Australia, but there's always a risk. And there's a risk with the cash under your mattress approach as well, that your house burns down, right?
Yep.
And so volatility is the price you pay for higher returning assets, and typically the higher the volatility, the higher potential return, but also the higher potential loss. And so structuring a diversified portfolio that takes into account your investment goals, but also considering some of your behavioural responses to periods where the market may be down. And Charlie Munger had a view, if you can't withstand a 50% drawdown, then you shouldn't be investing in equities,
Correct.
For example. And there's been a number of times, whether it's COVID or whether it's the GFC, where investors have had to face 25, 30, 35% drawdowns within their equity portfolios. And the question is, be honest with yourself, how would you react if that occurred again? Now, what a well-diversified portfolio can do for you is that if equity markets sell off 35%, well then hopefully the defensive portion of the portfolio is doing well. And what professional money managers would do is actually rebalance back towards equities, because by definition you're selling defensive assets when their valuations are higher, and you're buying growth assets when their valuations are lower. And that's how you compound long-term excess returns over time. And you do that successfully, then I can guarantee you're going to have a good result when the end of your investment time horizon comes.
Yes.
But the ideal scenario is that you withstand the volatility on the growth side, the equity side, and you never have to capitalise a loss, because the defensive side of your portfolio is generating a sufficient level of income for you, or that you have access to liquidity where you never have to crystallise a loss on the equity side. And that's where leverage can kill, Buffett says, he said, very smart people, they get into trouble when they use leverage. And so if you face a margin call, you might love the stock, but you get margin called, or it's a levered position. It's where these really smart hedge funds can get into trouble, for example. Long-term capital management had a couple of Nobel Prize winners.
Yes, poster child.
Yeah, exactly. So my view is take equity risk, but talk to your advisor about structuring a portfolio where a scenario occurs where a 50% drawdown occurs on equities, but you never have to touch it. You can just let it run.
And with that, Doyle, thanks very much for your time.
Cheers, Jono. See you soon.
This podcast is not financial product advice and is intended to provide information only. It does not take into account the investment objectives, financial situation, or needs of any person. You should assess whether the information is appropriate for you and consider talking to a financial advisor before making any investment decisions. Any investment examples are for illustrative purposes only. The information is taken from sources which are believed to be accurate, but Simon Wu, Jonathan Wu, SWU Financial Planning, and Personal Financial Services Limited accept no liability of any kind to any person who relies on the information contained in the podcast. Unless expressly stated, none of the information should be taken as a recommendation. For more information, please visit www.simonwu.com.au.